Once in a blue moon, we get incredibly enlightened by some of the greatest investors of our entire generation, and today we're fixating on a guy called Ray Dalio that runs a hedge fund called Bridgewaters that manages over $17 billion, and he just dropped a bombshell of a video that I'm going to recommend that you guys watch, and we're going to break down his portfolio with his buys, his sells, some of the questionable things he's doing, and the opportunities right now of a lifetime in some of the specific companies he's buying. But the video that I watched last night was called The Principles of Dealing with the Changing World Order by Ray Dalio. I learned more in this 40-minute video than I have learned through my entire high school history classes, and I'm going to leave that link. I highly recommend you watch it. You're going to learn a lot about the falls and divides between currency growth and how empires have come and gone. It's really fascinating stuff. But for those of you that don't know Ray Dalio, this is what his current portfolio looks like. It comes out of this hedgefollow.com that follows his portfolios, his buys, his sells, his trades, and he has really dramatically shifted his portfolio because when I last reviewed this, he had large exposure to foreign index funds that gave you exposure to the emerging markets. And clearly in these turbulent times, we can tell he doesn't want exposure to those kind of emerging markets. And it looks like he's getting that exposure through US companies that have global diversification in the way they sell products. So before we kind of take a broader view of his portfolio, let's talk about the largest trades, because this is where things get unbelievably interesting. And the first and foremost, guys, in the last, I guess, quarter here, he's been gobbling up Alibaba like crazy here. He's increased the position by 29.73%, probably being one of the largest buys that he's done out of everything he's done in the last quarter. And just take a look at Alibaba today, guys. It is now trading so far down. I mean, from its all-time high, guys, it is now down 70%. This thing ceases to find a bottom and is still waiting on my buy list for the turnaround. Now, the reason that I think he wants so much exposure to China, or primarily some exposure to China, is in that video, you'll notice that he really talks kind of indirectly about how China is this upcoming superpower that could potentially take control of the world reserve currency. And he explains again in that video how world reserve currencies come into being. But take a look at the Chinese yuan. This thing against the US dollar has been rallying aggressively since the 2020 crash here, guys. Like, it's incredible to see that if you're kind of a Forex trader, that the yuan has been a great place to park capital against the USD. Now, taking a look at some of his other big trades, Procter and Gamble. Now, this is one of those most foundational companies that anybody can put in their portfolio. He's been adding an extra 10.7% here. And let's just talk about Procter and Gamble, because I have been dying for the day that I can re-add some of these mega cap dividend growth beast aristocrat companies to my own personal portfolio. And I mentioned that if these things ever tank like they are now, I would be selling off index funds to start redirecting capital this way. Now, let's take a look, because right now, unfortunately, we're only down 11.4%. I think we're going to be heading into a recession that the Federal Reserve has been holding off on raising interest rates for far too long, and every indicator from past recessions are coming up again and again and again, and we're just seeing a delayed response from the Fed. So whether we head that way, I'm speculating that we are, and these companies unfortunately are going to get pulled down with that out, the tide going out. But the reason that I want you to pay attention to these, you don't even have to look at trading them off the stock price or trying to buy the dips. What I primarily do is just look at the historical dividend yield, because right now these dividend yields have been as low as they've been in a very long time. But if we go back to even 2018, Procter & Gamble was paying a 3.6% dividend yield, and historically it's been as high as 3% on average. And right now we're coming out of the 2% lows. So as this thing approaches 3%, that's when I'm going to use the indicator to start buying back into it. And I think we've got a lot lower to go on some of these companies that are being affected by inflation and obviously logistics problems, and Procter & Gamble is no exception. But with a $347 billion market cap, if you can buy one of the largest companies in the world that's exposed to things like toothpaste and toilet paper, by God, this is one you don't want to miss out on. Continuing on here, folks, let's talk about Pepsi, one that I already have large exposure to, with obviously the raising prices of aluminum. They produce a lot of aluminum cans, a lot of those packaging goods. We're going to start seeing those prices affecting our daily lives. But let's use Pepsi as another one of these indicators. Right now, guys, it's trading down 12% with a 2.78% dividend yield. When I was buying this, it already had over a 3% yield. My average yield on cost is around 3%. And we can see historically, once in a blue moon, this thing will peak over 3%. And I would use that as an indicator to start buying into it as well. Now let's take a look at a couple of the other ones with Johnson & Johnson and McDonald's. Now, in these historical recessionary periods, typically we see an outperformance in commodities, healthcare, sometimes financials if it's an interest raising environment, depending on how bad the economy is impacted, because obviously 2008 was not a time to own financial stocks. And then obviously you have a few other sectors that will be outliers, but I really think healthcare is going to do just fine through this. And just taking a look at Johnson & Johnson here, from its all-time high, it's down 5%. It's definitely outperforming the S&P 500. So it would be no surprise that the historical dividend yield doesn't really bump up that much. And we can see going through the past year, it looks like it hovers between 2.5 and 3%. So as it kind of gets to that 2.7% range, we could easily use that as an indicator to start cost averaging into it here. Now let's talk about McDonald's real quick. So I have this list of companies that I have been following for a very long time. I took some strategic investments in the March 2020 crash, primarily focusing on REITs and financials, which did exceptionally well. But what I missed out on was the incredible dips in these lifelong companies that you should look to acquire. And McDonald's is no exception to that, guys. And it's currently trading down 17% with a starting yield of 2.4%. Now, I haven't been really talking about the PE ratios, but these things are starting to go back to the teens, and that's when things get very attractive. Now, again, just using the dividend as an indicator to buy rather than focusing on trying to figure out when the stock's at a good valuation, because these companies, I don't think the value matters as much, is just holding them over a 30-year period of time. But we can see here, guys, the historical dividend yield typically bleeds between 2.5 and 3%, but we've only hit 3% like 7 years ago. So I have a hard time believing we can get back to that 3%. So honestly, if you're looking to pick this thing up, once it gets to that 2.5, 2.7% range, could be a good indicating time to do so. But whether we go down farther from here, I don't know, man. These things can drop so low, but there's going to be some attention coming back their way. Now let's talk about the stocks that he's selling, because as I mentioned, he's been really exiting these kind of emerging market index funds. And again, anybody invested in Russia, China, just been getting absolutely slaughtered. So it looks like he's been trying to wind away from those markets. He sold off 2 of his largest holdings here, which he dumped massive amounts of. I mean, all of these, look at this. 3 of his major sells have been all emerging market index funds. These were one of the largest proponents of his portfolio. Again, not even like a year ago, guys. And what I found more intriguing was Walmart. Why is he selling Walmart? So I didn't really understand this, because Walmart's another one of these foundational companies, recession proof. We're all going to need to buy these products and use the store. Walmart's been around forever, right? It's one of the largest companies in the world. But the reason I think he's selling Walmart is because the valuation is extraordinarily high. And I've said this about these shopping places. Like, I don't know how Walmart, Costco are able to trade at such high valuations, considering you can buy Facebook close to the teens now, but you can't buy Costco under a 42 PE. The weird thing that I find about this, though, is these companies have been performing very well through the volatile moments here. But what's most intriguing is in his top holdings, it doesn't really look like that he got rid of Costco by any major degree, because it's still one of the largest positions in his entire portfolio. But taking a look at this from the broad view, I find it intriguing that for a guy that's been through a lot of these periods in time isn't buying gold. Like, I just feel like commodities right now are going to be one of the hottest markets in recessionary periods, and through all the ups and downs, people know commodities are the place you want to be for long periods of time, because they're always going to be needed. Always going to be needed, guys. Gold, uranium. I mean, oil, people thought oil was dead, and here we are back in a new oil renaissance. But just intriguingly enough, guys, like, yeah, gold's way at the bottom of his list here. But again, we've got some other really intriguing stocks that are very foundational, falling off a cliff right now, like Starbucks. And he's got a little exposure with JD here, some more of those Chinese stocks. So I feel like, based off that video that he released, he's more inclined to think China has capability of being a new world superpower. So we can see how he's exposing himself to those sectors, even with some of these companies, obviously like Procter & Gamble, Pepsi, Starbucks. All of them have global exposure with large Chinese exposure here, guys, even all of these companies, right? So I find this very, very intriguing. And I want to pass that question off to you at this point, guys. I know this is kind of just a really quick insight into what Ray Dalio is doing, but the guy is literally managing over $17 billion. His iconic is Warren Buffett and outperforming the market in the historical period he's been in the market. So very intriguing stuff. Tomorrow I'm going to update you on my portfolio and some of the stuff that I mentioned in here, and how I want to take advantage of the drop in Procter & Gamble, McDonald's, Starbucks, and what I end up doing. So consider subscribing for that. Bring that video out on the weekend, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.